Hello, this is Joe Hoyle at the University of Richmond, and in fact I'm doing this video before I go teach my class this morning. Today we're going to talk about the statement of cash flows. This chapter is different. It is only about one thing, and that is the creation and understanding of the statement of cash flows. The other chapters tend to be about numerous things. This chapter focuses entirely on the statement of cash flows. And the statement of cash flows itself is different. It does not reflect several accounts. The balance sheet, for example, has all of those assets and all of those liabilities and contributed capital and retained earnings. The statement of cash flows, as the name itself tells you, takes one account, the cash account, and tells you how it changed during the year. People who look at financial statements, people who study organizations, want to know how the company's management utilized its cash. That's the purpose of the statement of cash flows. So now that you've read this chapter, I hope you've taken time to pick your top 5 things in the chapter. I have my top 5. Let's get to work. Let's see what was important about the statement of cash flows. Here's number 5. In studying this chapter, I believe that the 5th most important thing was the concept of balance sheet connectors. The income statement is produced using accrual accounting. Revenues are recognized when substantially complete. Expenses are matched with those revenues. However, in the statement of cash flows, you're trying to determine how much cash you got. Therefore, those income statement numbers must be switched from accrual accounting to cash accounting. In the recognition, there is always a balance sheet connector between the recognition and the cash. For example, you make a sale on account on Tuesday, so you recognize the revenue on Tuesday, but you collect the cash on Friday. Between Tuesday and Friday, the balance sheet connector is accounts receivable. You have employees. They earn money. You have salary expense. You do not pay them for 2 weeks. Between the earning of that expense and the payment, the cash portion, you have a balance sheet connector, salary payable. So in your income statement, those figures are created by accrual accounting. But when you get ready to come up with operating activity cash flows, you need to convert those into cash. You factor in the balance sheet connectors. But it's not the balance sheet connectors, it's the change in those balance sheet connectors. For example, you take the operational assets. Operational assets are those things that change on a day-to-day basis because of operation. Accounts receivable, inventory, supplies, prepaid expenses. If they go up, that means that they are taking away from your cash. For example, if accounts receivable go up, you're collecting less. That takes away from your cash. If inventory goes up, you're buying more. That takes away from your cash. So if a balance sheet operational asset goes up, you have to factor in that you have less cash when you come up with your operating activities. In the same way, when you have an operational liability, account payable, salary payable, rent payable, and the like, if they go up, you're saving your cash. You're paying less. If rent payable goes up, it goes up because you paid less. Therefore, when you determine cash flows from operations, that change in that balance sheet connector has to be included in determining the cash flow from operations. That to me was a very interesting concept. Had to think about it a lot. We explained it very carefully in the chapter, and for me, that was the 5th most important thing in this chapter. Number 4, and I think this is important to not misunderstand the statement of cash flows, is that you add depreciation expense to net income when you're coming up with your operating activities if you're using the indirect method. Now, you already know from the chapter that the companies, by a vast majority, use the indirect approach. And in the indirect approach, one of the things you do is to take out the non-cash items. And by far, the biggest non-cash item is depreciation expense. That's a negative in net income. So therefore, to take it out, you have to add it back. That eliminates the depreciation expense. When you look at most companies' statement of cash flows, and you look at the operating activities, you will frequently find net income and then the addition of a large depreciation expense. Many people misunderstand that completely. They start thinking that depreciation expense increases cash flows. No, that's not the purpose. You're trying to determine how much cash you got from operating activities. To do that, you want to take out the amount of non-cash items. To take out depreciation, you have to add it back. For me, because that's easy to misunderstand, I place that at number 4. Moving now to number 3. When I read this chapter, I was very interested in the fact that the FASB prefers the use of the direct method to come up with operating activity cash flows. And we demonstrated how that direct method was used. But in real life, almost every company uses the indirect method. Now there are several reasons we present in this chapter for using the indirect method. One is it's just the traditional approach. Accountants tend to be people who stick with what they've done before. But there are other reasons why the indirect method is popular. But FASB prefers, and you can see why. It shows where the cash came from and shows where it went. But the companies present the indirect method. However, both methods operate in the same way. They start with income. The direct method starts with the income statement. The indirect method starts with net income, but they both start with income. They both take out or eliminate non-cash items. They both take out or eliminate the non-operating items. And then they both factor in the changes that have occurred in the balance sheet connectors. As I mentioned earlier, for example, if receivables or inventory goes up, that takes away from your cash. If accounts payable, salary payable go up, that saves you cash. That impact has to be taken into consideration. Both the direct and the indirect method come back to the same final total, but they do it in a different way. When you look at financial statements, you almost are assured to see the indirect method. Now, number 2. I felt that the entire classification system of cash flows was extraordinarily important. When you look at a statement of cash flows, you see investing activities, you see financing activities, you see operating activities. To fully understand the information that you're seeing, you need to know the difference. Investing activities do not happen as part of daily operations, and they involve assets. You buy land, you sell a building. Financing activities do not affect daily operations, but they deal with either a liability or stockholders' equity. You issue a bond payable, you pay a dividend, you buy treasury stock. All of those are financing activities. And finally, the operating activities is the amount of cash that you got from the day-to-day operations of your business. In my own classes, I'll often assume that we as a class start a pizza restaurant, and then I will say the operating activity cash flows is the amount of cash that you got from selling pizza and the like. For me, because that classification system was so essential in understanding the statement of cash flows, I place that at number 2, which brings us, of course, to number 1. The number one thing in this chapter, at least to me, as I judged what you're seeing, was the tremendous significance of the amount of cash that you get from operating activities. That to me is such an important number that I thought you needed to really think about that number. If you have a business, if you're looking at an organization, there are lots of things that you can look at, but very few of them are as important as how much cash the company can generate from its operating activities. Once again, if you're starting a pizza restaurant, eventually you have to determine whether you can get enough cash from that operation to make it worth your while. Investors look at that number. Decision makers look at that number. I wanted you to recognize its significance, and I placed it on my list as number one. We've looked here at the statement of cash flows. Presents a lot of interesting information, but it's different than the other statements. It takes that one journal entry, that one T account, cash, and tells you where the cash came from and where the cash went. This has been the statement of cash flows. I think it's well worth your understanding. Work hard, learn it all.